Michael Saylor is a business leader who made Bitcoin a cornerstone of corporate treasury strategy.
This is the year that digital credit emerged as a real asset class. It's now more than $11 billion. 12 months ago, it was $0. There was nothing. The entire asset was invented in the past 12 months, and it's been extraordinarily successful, growing very rapidly. And that is one of the killer apps on top of Bitcoin. Digital credit is what allowed us to buy 175,000 Bitcoin this year in the middle of a bear market. So digital credit is meaningful driver of the marketplace right now and supporter of the network. And then the third thing that's just really exciting is now we can see a path to plug Bitcoin into every bank, every money market, and every investor in the world through digital money. People used to dream a decade ago, they dreamed about a Bitcoin-backed stablecoin, and wouldn't it be great if I had a coin like Tether, but it paid me 8% or 6% or whatever, and no one could ever create one. And
what if Bitcoin never reaches another all-time high for the next 40 years? Will the biggest Bitcoin company in the world survive? What if the biggest risk to Bitcoin isn't a market crash, but 40 years of absolutely nothing? It sounds impossible, yet that's the exact scenario Michael Saylor challenges. Instead of assuming endless bull markets, he asks whether a Bitcoin-based business could survive if the world's largest cryptocurrency delivered zero returns for decades. Surprisingly, his answer is yes. The real story isn't about predicting Bitcoin's next rally. It's about building a financial strategy that can withstand the worst-case scenario. According to Saylor, even if Bitcoin remains completely flat for nearly 4 decades, the company still has multiple options, including refinancing debt, restructuring its capital, and adapting its products. In other words, the business isn't betting everything on constant price appreciation. But here's where the conversation becomes even more interesting. Saylor argues that Bitcoin doesn't need explosive growth to make the model work. An average annual return of just 3% could allow the company to sustain itself indefinitely without issuing additional common equity. If Bitcoin compounds closer to 8% or 10% annually, the company's stock could potentially outperform Bitcoin itself because its financial structure amplifies the asset's returns. That reveals the true investment thesis. This isn't a strategy designed for traders chasing the next bull run. It's built for investors who believe Bitcoin will remain a valuable digital asset over multiple decades. Whether that assumption proves correct will ultimately determine if this approach becomes one of the boldest financial experiments in cryptocurrency history. Do you believe Bitcoin can outperform traditional assets over the next 40 years? Or is this strategy taking too much risk? Share your thoughts in the comments below. If you enjoyed this analysis, don't forget to like, share, and subscribe for more in-depth crypto insights and Bitcoin market breakdowns.
if Bitcoin stalls for the next 40 years, like for the rest of your life, then somewhere 30, 35 years from now, we'll run out of money. So we have about 30 to 40 years of dividend coverage. So if Bitcoin stalls, which means goes up 0% a year for 40 years, then sometime in 35 years or something, by the way, if we do nothing, if we do nothing for 35 years and if Bitcoin stalls, then in 35 years, we wouldn't be able to pay the dividend. We wouldn't do nothing, right? We would refinance or adjust. And so practically speaking, probably we have 40 to 50 years if Bitcoin stalls. We have on our web, by the way, we publish that number, the years of dividends, right? And the cash and the Bitcoin coverage. We also calculate Bitcoin break-even ARR. If Bitcoin appreciates about 3% a year, and this number is updated every 15 seconds on the website, if it appreciates 3% a year, we can pay the dividends forever without selling a single share of common stock. So the machine finances itself forever, indefinitely at 3%. It finances itself for the rest of your life, or about 35 or 40 years, at 0%. If Bitcoin appreciates at our stochastic cost of capital, like our probabilistic cost of capital over the next 20 or 30 years, call that somewhere between 8 and 10%. then the equity outperforms Bitcoin. Right, so the equity is actually a screaming home run. What if Bitcoin is 10, and our equity will probably be 15 or something, and if Bitcoin goes to 15% ARR, our equity will be 20, 25 because we're amplified. And so the real numbers to keep in mind are 0 versus 3 versus 9. And so a lot of times people think they just have these misnomers like, well, you need Bitcoin to go up 30%. No, I expect it to go up 30%.
Based on history, yeah.
I need it to go up 3%, sort of. But even then, the company has incredible optionality and operational flexibility. There's a lot of things we can do. We can do all sorts of refinancings, and we can create other products, and we can modify products, and we can adjust. So as a practical matter, most people, their attention span is 12 months.
Or
right?
less.
Yeah, so in this particular case, there aren't many people in the Bitcoin community that think that Bitcoin will languish for 40 years. And the truth is, what we would say, and this is not controversial. If you're an equity investor and you think that Bitcoin is not going to outperform the S&P index, you probably shouldn't buy our equity. I mean, our equity investors, they think Bitcoin is as good as the S&P index or better. Most of them are Bitcoin maxis. They think Bitcoin's going up 20 to 30% a year, and they want to. I think our equity has been 48% a year for the past 6 years. So we're performing about 50% a year, and Bitcoin is up 33% a year. So the equity investors normally are maximalist, and they believe in the asset. And from them, they're just doing this because they want to get 50% a year, right? The credit investors, if you think that Bitcoin is an illegitimate asset and it's going to go to 0 tomorrow, or if you think it's going to fall 10% a year every year forever, you don't want to buy the credit.
Billions are leaving Bitcoin, but the real question is where that money is going and what happens when it comes back. Capital flows in crypto markets rarely move in a straight line, and the current phase highlights that reality with unusual clarity. Large pools of institutional money are rotating away from Bitcoin and into high-profile opportunities across artificial intelligence, IPO markets, and private tech deals. Billions are being allocated into names like major AI-driven firms and late-stage private companies, where short-term price momentum and perceived upside are attracting aggressive capital positioning. In this environment, Bitcoin is not necessarily losing structural relevance, but it is temporarily losing attention within a broader liquidity cycle. Michael Saylor frames this shift as a classic rotation rather than a fundamental breakdown. Capital is not disappearing from the system. It is simply searching for faster returns in newer narratives. As funds chase these emerging trades, Bitcoin experiences relative capital drainage, which often reflects in price consolidation or underperformance compared to equity markets. But what happens when those high-growth narratives cool down? According to this view, once speculative enthusiasm around AI and IPO cycles normalizes, capital tends to reassess relative value across asset classes. At that point, Bitcoin may reemerge as a preferred destination for institutional allocation. The key question becomes, is this weakness a warning sign, or is it the quiet accumulation phase before the next major capital rotation back into Bitcoin?
It turns out that it has pulled 10, 15, 20 billion dollars of capital out of the crypto economy. Institutional investors have sold 5 to 10 billion dollars of ETFs and things like that. So it's pulling some capital, but of course Bitcoin is not funding all of this. Bitcoin is like 2% or 3% of the capital. That capital is being pulled into these hot deals. Every banker on Wall Street is out marketing the SpaceX deal, marketing the Anthropic deal. Let's get in on it. I know I'm going to get a 10 or 20% pop because the bankers, if they're going to do the deal, they're going to have to make the deal pop 10 or 20%. So I'm going to get in on the deal and then I'll get out again. And so I think capital is being pulled into all these hot deals. They're all competing for capital. When we get through IPO summer or AI summer, I think a lot of that hot money will come back into Bitcoin because Bitcoin is now undervalued. If you want to look at Bitcoin, you can look at the premium or discount to the 200-week moving average. which is kind of like the book value of Bitcoin, or you look at the realized price, and what you can see is when the market's hot, it trades at 100% to 200% premium. And then when the market chills and the leverage comes out, it trades at that number or maybe at a slight discount. And so what you're seeing right now is this capital cycle. The more Bitcoin, has capital drain out of it, the more compelling the price is, the better the value. At some point, those capital investors, they're not maximalist in anything. They're not religious ideologues. They can be excited about this deal this week. They'll be excited about another asset next week. And they're all looking at relative value. So I think that equity markets have been performing well because they've been juiced by Nvidia and Google and some of the AI story, and Bitcoin hasn't been getting that lift. But I think that after these deals flow and after capital settles, I think that a lot of the capital will flow back into the Bitcoin and Bitcoin related securities. Probably the third quarter. And I think by the fourth quarter, things will be normalizing to our...
What if Bitcoin isn't actually losing strength, but is quietly being sidelined as capital rushes into the next explosive narratives? Right now, billions are rotating into AI stocks, IPOs, and private mega deals, leaving Bitcoin in a temporary liquidity shadow. But is this really weakness, or just the early stage of a larger capital cycle that most investors are misreading? When markets chase news stories, capital doesn't disappear. It simply moves. And when that excitement fades, history shows the same question always returns. Where is value actually building long-term? Could Bitcoin be setting up as the next destination once these high-risk trades cool down? The real uncertainty isn't what Bitcoin is doing today, but what happens when this wave of speculative capital reverses? Does it stay in equities? Or does it flow back into digital assets with stronger long-term conviction? In a market driven by rotations, timing may matter more than sentiment. Is this just a temporary capital rotation, or the beginning of Bitcoin's next major move? Share your thoughts in the comments below, and don't forget to like, share, and subscribe for more crypto market insights. Do you think capital is temporarily rotating out of Bitcoin into AI and IPOs, or is this the start of a longer shift away from crypto?